Hello, Neil Young here. I'm the Managing Director of ASX-listed Elixir Energy, an oil and gas company who currently is primarily focused on a very large and well-located tight gas play in Queensland, Australia. Let me tell you more about this. So here's an overview of the natural gas market internationally and as it pertains to where we're located. Three key points. Firstly, I think it's been recognized in the last 12 months by multiple stakeholders that the desired energy transition is very hard and that natural gas has in fact a growing future for many decades to come. On the international side, LNG demand is expected to rise by parties like Shell, and in particular in Asia, which is served by suppliers such as Australia over many years. We are a reliable supplier to key allied nations such as Japan, and we expect that to continue into the future. Where we are located on the east coast of Australia, there is a growing supply shortfall. There is political mistakes made over periods of nearly 2 decades have caused that. The government are now recognizing this, but in fact, prices have risen substantially. We currently see a floor of about $12 Australian, so that's about $8 US. So that's 4 times higher than Henry Hub just now. We see LNG imports happening in some of the southern east coast states at the same time as LNG exports occur from Queensland. That's not the only place in the world like that. We see, for instance, that in Boston versus the south of the USA as well. So the East Coast gas crisis is upon us. Politicians are reacting. Prices are high. We are very well located to supply into that market. Our asset is located proximate to large transmission infrastructure that takes gas to southern markets, as well as the liquefaction plants that sit in the Port of Gladstone, Queensland. So going to the company, here's our team. Our chairman is Richard Cotty, a very well-known veteran of the gas space in Australia. Myself, I've been working in energy for nearly 30 years. Stephen Kellerman worked for Santos, one of our largest energy companies, for over 40 years. Anna Sloboda, a finance industry specialist, well placed to help the company deal with finance issues, as well as having experience in Russia and China, which are relevant to our now non-core business in Mongolia. We have quality partners and suppliers. We struck arrangements with some of our neighbours, Origin Energy and Santos, some of the largest companies in Australia. Our service sector needs have been met by Schlumberger, Halliburton, Condor, and also of key interest, we managed to get an advanced finding from the Australian government that our program initially in our project would qualify for an R&D tax credit, which pays us cash of 48.5% of the cost of our initial stimulated well, which is called Daydream 2. So here quickly is our capital structure. It's slightly out of date. We've done a raise recently. We've got a bit more than 1 billion shares on issue. Our share price just now is about 10 to 12 cents. Our liquidity is high. We are a widely held company that trades, and liquidity is, of course, attractive to incoming shareholders, be it on market or through capital raises in the future. So the Taroom Trough also hosts a large number of downstream market opportunities. There are quite a number of existing gas-fired power stations and significantly plans for many more. The introduction of significant intermittent renewables into a system like Australia's, and this is true globally, means you need a lot more gas-fired power stations to balance the system, and we're engaging in an early stage with potential customers on that front. This area we believe is attractive to large sources of capital. We're a junior company. Our market cap's just over 100 million Australian dollars. How does a large asset like this get developed? It gets developed by us bringing in large partners. How do they come in? Well, firstly, this is brownfields. Big companies are already there. Shell, I've mentioned. They like low emissions profile. This asset is low in carbon dioxide. They like scale. Now, we alone have booked 1.4 TCF of 2C contingent resources, and we believe that's only a beginning. Low sovereign risk is important, and Queensland is one of the better states in Australia, which is one of the better places in the world. And then investments can be varied in an onshore location to meet market needs. This is not a deep offshore single FID project. So there's multiple operator activity. We're undertaking the Daydream 2 well just now. Shell are undertaking a significant, at least year-long program of multiple horizontal wells. Santos hosts acreage to our north and south, and a company called Omega, a peer on the ASX, is undertaking work almost as we speak in our southeast. Now, multiple operators trying different things in a large unconventional resource play has been illustrated time and time again in America to be key to unlocking that play. Do you do vertical wells? Do you do horizontal wells? How do you stimulate them? Those are all issues that get worked out the more activity that takes place. And so activity is for the benefit of all. We're not competing for market here. The market's effectively infinite from the point of view of any particular operator. So Daydream 2, we drilled it at the end of last year. We are about to recommence a stimulation and flow test program. We had multiple objectives, all of which have been exceeded to date. We wanted to intersect more than 500 meters of gross vertical pay in the Permian section, which we achieved. We undertook DFITs to evaluate stress and design our stimulation program and qualify for the R&D tax credit. We wanted to confirm that CO2 was low, which we've done. To date, liquids is low as well, which helps flow in a tight gas formation. We've expanded our initial contingent resources, and now we're moving to finalize our stimulation program. We got one stage away, but didn't flow test it a few months ago. We fixed a mechanical problem which temporarily interrupted that. And we want to gather data in the next few months, which will allow the design of a significant, scalable, at least 500 well development. End of last year, we got a welcome surprise. For the first time ever, we flowed gas from a tight formation of 4,200 meters. We intersected more pay than we expected. We logged a lot of net pay. We measured a lot of coals, which aren't yet in the pay, but we plan to move them into that. We see analogs with one of Australia's biggest success stories in the last 10 years, the deep onshore Perth Basin, the other side of the country, which has been a centre of immense corporate activity and investment. Lab results delivered more upside. We think we've established why we got to primary permeability and porosity at these deep, high-pressure depths. And that's through preservation of porosity through clay coatings on quartz grains. We also measured very high gas contents. This is the first time ever in deep coals at 3,500 meters and deeper. The gas in place in these coals, given the size of the acreage and their thickness, is enormous. If we can even get a small recovery factor on that, there are TCFs of gas involved. And as we keep saying, CO2 levels are low, and that's critical for investment. Initial flow tests were very good. We got a stabilized rate of 1.3 million a day in this high gas price environment. That is almost halfway there, or is halfway there, to commerciality. Here's a graph. Those stabilized rates are very clean. And we undertook two in a sort of 2 a day so period back in April, and we're about to recommence the program and look to improve this. We believe we've opened up a whole new play. In American terms, this is vastly underexplored. If this free-flowing Laurel sandstone is pervasive, it will change the economics of what previously has been considered to be only an unconventional play immeasurably favorably. So next few months are critical. We are currently imminently about to undertake the milling of a plug set above the Laurel. We flowed that pre-stimulation. It was stimulated but not properly flow tested. Hopefully within a week we'll be able to announce the results of the post-stimulation Laurel, and that should hopefully be significantly better than the 1.3 pre-stimulation. We will then perforate and stimulate 5 zones above that in the large Permian section. And we'll set plugs above each level as we do so. Then at the end, we'll mill them all out, flow test everything, and see what we get. We are pretty confident we can exceed a commercial flow test rate, which we've announced to the market is only 2.5 million a day. And once we do, or presuming we do, we can start to convert contingent resources into reserves. We recently expanded our acreage here in Queensland as a process of government award of acreage on an annual basis. We were a successful tenderer. We added a license, which is comprised of 3 separate geographical areas, 2 of those are in the Taroom Trough. We expect that license to be awarded soon. We are preferred tenderer at this point. And when it does, we would expect a contingent resource position to increase and add to our resource base at a very low finding cost. In the southwestern part of this, there are very shallow targets, which are conventional, quite different in size, but quite different in economic characteristics. And we'll be looking at that. Well, in fact, we are looking at that just now, and we believe that to be attractive to potential farminees for various reasons. Last but not least, our now less focused asset is a very large production sharing contract in Mongolia on the Chinese border. This is a coal bed methane target. We've been working on this for 5 or so years. We're currently conducting a pilot test. This flowed gas early, which we believe was gas in the cleats. We're now achieving depressurization of the coal seams through pumping of water on measured rates, and we are aiming for gas breakthrough by the end of the year, and presuming we achieve that, that should open up opportunities for partnerships with parties who are significant operators in the region. So there's a graph of that falling pressure. So in summary, the world needs more gas for longer. This is explicitly now recognized by Australian federal government policy. In the east coast of Australia, which focuses our grandest asset, we have very strong pricing, a growing and imminent supply gap, and LNG plants with spare capacity. The Taroom Trough, where we are and where there are multiple other operators of substance, has great locational advantages to serve those markets. So I mentioned those operators. We and others in total are spending hundreds of millions of dollars to open up this play. Early success from the Laurel Sandstone will change this from a wholly unconventional play into a largely unconventional play that can be assisted by the better economics of free-flowing zones. And we're about to conduct work imminently. We expect results within a week, and then following in the weeks after from the flow test here, and then the months thereafter as we proceed to see where we can get to with partnership discussions with very large players who are keenly watching what we are doing. So that's it from us. Expect an announcement shortly. Plenty happening here. And yeah, thanks for listening to me today.